Up next, we have the fireside chat with Mr. Kunal Bahl on what are the pitfalls that early stage founders should avoid. Kunal Bahl is a technology entrepreneur and investor. He is the co-founder of AceVector Group, which is the holding company for Snapdeal, Unicommerce, and Stellaro brands. Kunal is also the co-founder of Titan Capital, which has backed world-class entrepreneurs with operator-led early-stage capital in 250-plus startups, including edtech startups like TechMint, BlueLearn, Invact, Yellow Classes, Skillovilla, among others. Kunal is an influential voice on issues pertaining to Indian startups and entrepreneurship. He will be joined by Mr. Rajendra Singh Pawar, Chairman and Co-founder of NIIT Group. May I request the audience to type in their questions by clicking on the Q&A icon. They will be answered at the end of this session. So without any further ado, over to you, sir.
Thank you. Thank you, Neha, and thanks, Kunal, for your time. With 250 investments, I don't know what all keeps you awake and what lets you sleep, but I'm sure now you've come to a point where it matters less and less, and therefore you can sleep better and better. I'm sure that is so. Now, for everybody who's listening, I do want to say that I talked to Kunal briefly, and I was saying that pitfalls, and he said, look, why talk of pitfalls? Let's be a little more positive on things. And while I agree with him, I do think that, those who have done the path, look back at some things which we could have easily avoided, right? In hindsight, they look damn easy and say, forget it. But then if we can stand on a hillock and watch, and we see most people fall in that pit, right? So some pitfalls are therefore easier to see in hindsight, but remain invisible, even though people may learn or read about them. So it is in that context, Kunal, having watched so many people walk the path, that you're in a very special position to really start generalizing on something which, oh shucks, I hope this guy doesn't do it, and everybody seems to do it, and so on. So I do want to start by saying that, 2 or 3 things which you've seen to be such things which are highly avoidable, but most people don't see till they get there. Maybe let me start by your listing 2 or 3, and then we'll get into a little more detail.
Sure. So firstly, thank you for having me join this incredible forum. I was listening in on the prior discussion with a lot of interest, and I really appreciate giving me the opportunity to participate in this forum. And sir, you yourself are an inspiration for generations of entrepreneurs, including myself. So it's always a pleasure to be speaking with you. Look, I feel that you're right. I think over a period of time, one does start seeing patterns across segments of companies and stages of companies. And look, none of the founders, I feel, make those errors knowingly. They have the right intentions, they have a lot of ambitions, they have starry eyes, but sometimes it is those starry eyes that lead them to a place that they shouldn't have gone to. And even from my own personal experience, I've learned some of these lessons. I would say the first and foremost one would be just lack of focus. It is always more exciting, and it is always more celebrated by the media when companies do a lot of things. They become like a factory of new initiatives, where they are launching a new initiative a week or every month and putting out press releases and giving interviews, and everyone likes their name showing up or their company's name showing up in the newspaper often, at least in the
I think image is frozen. So Nishit or someone, just see what we can do.
I think Kunal's internet is down, perhaps has just gone down. Maybe he'll come back. He'll have to rejoin.
Okay, so yeah, he's back.
Yeah, he's back. He's back.
Yeah, sorry about that. I don't know. I got bumped out. So I was saying, so one is obviously focus. Just moving to the next one would be, there's a lot of talk of profitability. I heard in the prior session, there was also talk of profitability. I actually feel that it's not that founders are just waking up to profitability as something that they need to pursue now. Profitability was always the guiding metric. It's just that nobody knew, or most founders didn't know, even investors, I would say, didn't know how much time would it take and how much money would it take for this company to become profitable. So in the era of when money was coming thick and fast, it was one of those things that kept on getting kicked down the can, that kept on getting kicked down the street. But profitability has always been the guiding metric. But now founders are obviously realizing that it has to come sooner. And related to profitability is just focus on unit economics. Even if the company is very small, it's only in its third month of operation, you can start telling whether you can say that whether this is a 10% margin business or a 50% margin business. And it's rare for a company to go from being a 10% margin business to a 50% margin business over time and yet be in the same business. It can go from 10 to 50, but it likely will be a different company or a different business, different industry, different sector altogether. So knowing whether it's a squirrel with a tail or elephant with a trunk is very important in even at the earliest stages, because it's almost like launching a projectile where depending on whether it was 3 degrees or 6 degrees, you land on Mars or Pluto. So I would say these are the 2-3 things, which is focus, profitability, and obviously within that unit economics of the business.
I think that's a good start, and in many ways a good summary as well, but we'll come back to that. So first thing I want to probe your mind about is, this whole issue of what drives most entrepreneurs. And I know it's not easy to come to this, but I know that very often, and I saw it in EdTech, that when some sectors really blowing into good, massive kind of size, a lot of people who are get more carried away by that opportunity in that sector and may or may not have a deep emotional connect with that subject. And but when things are normal, perhaps people connect a little more with what's driving them. So, of course, to me, my view is you have to first get in touch with what's driving you. But what have you observed, and it's also not very easy to tell people figure out what's driving you. So this whole issue of the external motivations and intrinsic motivation, how do you see this playing, and what's a bit of advice for people to? Yeah,
I feel that chasing the hot sector will give you pleasure, but chasing your passion will give you happiness. And in many times I've seen founders like, Web3 is hot. Everyone is running after Web3. And within 3-4 months, they realize they have no point of differentiation. They have no category context in their minds. And there is no reason for them to succeed in that category or that sector. So I do feel that it always starts from a place of personal passion, where you feel you can have enduring, interest in that space, because as sir, as a very successful entrepreneur, there'll be so many twists and turns in the journey. Most things will not go as per plan, that if you don't have this irrational amount of energy and passion for the problem statement, there'll be many situations that'll make you give up. So it does start from a place of passion and interest. And that's why I always would guide founders that, hey, take your time to decide what you want to do, because this is going to be a 10, 15, 20, maybe 30, 40-year journey for you. Why do you want to decide in 2 weeks what you're going to do for the next 10, 20 years of your life? So founders don't spend, they spend less than 1% of the time in deciding what they're going to do for 99% of the time, which seems completely irrational if you think about it. So I at least always will probe founders, like, why have they picked the space that they've picked, what interests them, what do they think can go wrong, what is the worst case scenario, what's the best case. Just try and go after it from different angles to make sure that more than me, they are convinced that they want to pursue this for, if people have a working life of 40 years, then at least for 25-30% of their working life, they want to spend on this problem statement. It is that important a decision. And with respect to the opportunity itself, I feel there are no bad opportunities. Most founders, there's always this obsession around, let's go after a large TAM. But there is nothing known as a large TAM, because all early stage companies start with a very, very narrow sliver of a problem statement. And then as they become successful in that and build some core competence in that, some reason to win in that, then they start adding more and more and more on the side to grow the TAM that they are going after. I've seen that most very good founders will figure out ways of how to grow the TAM versus starting with the largest TAM, because starting with the largest TAM means nothing, because it's not like you can go after all of it on day 0 or day 1 anyways. You can only go after a very narrow problem statement and deliver on that better than anyone else, so that you have the right to go after a larger TAM after that. But it all has to start from a place of personal interest, personal passion, and personal desire to make things better, like 10x better than they are being done in that particular space.
That's great advice. That's great advice. Now, one more thing I want to touch on, and since you have also put your fingers into EdTech, many parts of EdTech, is the whole area of regulation. I'm talking currently external regulation, not governance, internal. In areas like education or healthcare, which kind of sit somewhere in between what's a public good that government should deliver but cannot deliver, and therefore opens up to the non-government for-profit sector. At what stage in their thinking should startups or youngsters who want to get into this field invest time to understand that? How realistic is it to expect someone excited about teaching kids to even know there is something called regulation? And what is your observation here?
Obviously the Silicon Valley mindset has always been, throw caution to the winds, caution to the regulators, and unless you have the regulator slapping you on the wrist, you haven't taken enough risk. That's sort of I'm grossly generalizing, but that's generally been the Silicon Valley methodology, like go fast, break things, and that type of stuff. I feel that that approach, like, I personally don't completely agree with that approach. I feel different countries are operated differently for cultural differences, the business culture differences. Each country has its own business history. At least whenever founders ask me about this, I would always say that, look, let's try and build a business that's riding the tailwinds of regulation versus trying to find air pockets in regulation or points of arbitrage in regulation, because those are only a matter of time. It's only a matter of time that those usually get plugged. We've seen that over the last 1 year in fintech, where there were a lot of air pockets that companies had found in the financial services regulation and built good businesses which customers were liking. They were usually sat in a gray area of regulation. And then one fine day, a notification comes from RBI, and those businesses no longer can operate, literally starting that very moment. And I feel that why take such a risk? Why spend years of your life and your team's life building something that has such a binary risk, where you may have done everything right, but there's one very major thing that you did not do right, which is operated in a gray area of regulation. And for that, all the hard work, all the years, all the capital, all the team that you built, all of that can go waste. Rather, pick a space, pick a problem statement, or come up with a solution that's riding the regulatory waves, because regulation is not necessarily bad. Like, we think of regulation as a bad thing and it's something which is anti-business, etc. But that's not necessarily the case. It also helps to maintain decorum. It helps to maintain some amount of rationality and discipline in the way industries are built, and so that various market players play according to the same set of rules, and then merit wins. So at least that's been I know it's a slightly conservative approach coming from a tech founder, but it's the approach that has served me personally well in the choices we made when it comes to regulation. And it served the companies that we've had the fortune of advising and investing in well as well.
So this is one of those classical pitfalls which I talked about, that after you've been through it many times, then you can value it much more and look simple. So it's good you emphasize this, because I think there's a emerging kind of tightening on government regulation on this sector, and therefore better to invest time.
I would also add to it, sir, that a founder and a team and a startup have so many pressures and stresses and anxieties.
Yeah.
Why add one more to it, which is so catastrophic if it plays out the wrong way? Why add to it? Like I have no problem if I can sleep peacefully at night. I don't want to add anything on my plate that takes away the peace of mind and and having a good night's sleep.
Perfect. Then I want to talk a bit about, the dimensions of distinctiveness or uniqueness. Everybody talks about that in this commonplace, that you have to differentiate. So in this space, among the companies that you've been watching in the edtech space, are there any special one or two dimensions of distinctiveness that people can keep in mind? So when they're building the plan, they should think about the following things, one or two or three. Not too many. Distinctiveness you need on one or two dimensions.
Yeah, I feel that, everyone wants to build a world-class company, right? All founders, they come in thinking, I'm going to build the best company in the world doing whatever they are pursuing. But being world-class comes with being excellent at something, like 10x, 20x better than someone else. And being excellent comes with acute amount of focus, which is the point I'd earlier made in the first question also. And oftentimes, what one sees companies wanting is not that they don't know the fact that they need to be distinctive. The problem is that they know what they can be distinctive at, but they don't want to focus on it, because they always feel this fear of missing out on the three other paths that they could take. But going deep on one dimension of distinctiveness is usually more important than try and be a jack of many such jack of trades on many such dimensions. So one example from the e-commerce world would be Nykaa, for instance. Right? There was a time when all e-commerce companies about 10 years ago wanted to sell everything. And Nykaa came along and said, look, I will just take this one category, which is really very small. Nobody is paying attention. Let me just focus on that one category. And I'll build a lot of layers of capabilities and moats around that in terms of videos and influencers and celebrities and private labels and the way I do logistics, the way I do marketing and advertising, which becomes in aggregate highly irreplicable. And at some level, the distinctiveness was not in the fact in terms of the products that they were selling or the category they were selling. Distinctiveness was in the fact that they decided to focus only on that and then build all kinds of capabilities around that. So, there are obviously going to be many similar looking businesses, but I do feel focus around that problem statement that you've picked is highly underrated. And usually you don't find many companies go to the depths of pursuing that single problem statement.
And the last question, we did start 10 minutes late, but we'll try and at least save 5 minutes. We have another 4 or 5 minutes. Is that in raising capital, looking for capital, are there any one or two smart ideas? I don't want to say pitfalls, but any smart ideas based on what people have done and what they could avoid as mistakes? And
Look, I feel that founders at some level getting investment is, if you invert the statement, it's selling shares. Like getting investment is the other side of the coin is you're selling shares, and you're likely selling the most valuable product of the company, which is your shares, right? More than the service or the physical product that you manufacture as a company. So the right approach, I feel, is, approaching it almost like enterprise sales, where if you're going to sell some really expensive product or service, how do you do it? You would figure out that, okay, basis what I do, who is the right target audience? Not everyone is going to be my audience. If I sell, coffee cups, there's no point in me going to a fashion store, right? I'm going to go to home stores. So similarly, if there's an X type of business I do, if I'm running an EdTech business, I'd rather create the universe of all the EdTech investors in India and the world, and then create a big funnel at the top, because I cannot predict what the conversion rate would be. And then doing a lot of research on the investors, making sure that you're tailoring your narrative around the business to what the investor obviously has a thesis around. That doesn't mean, I don't mean that founders should be disingenuous in terms of just changing the business that they are in every time they meet a different investor, but it's about telling your narrative in a way that the investor would understand better. And obviously, so that is on the investor selection and how to go after them and how to create a funnel, not dissimilar from how enterprise sales is done. But I also feel that additionally, what many times founders don't pay enough attention to is how much the investors care about the broader team. There's often a lot of emphasis on founder, but actually what we look for when we are making investments is who else is on the team, even if it is two other people outside of the two founders, because that gives a good sense for the quality of the barometer of talent that these founders think is high quality, because that sets the tone for rest of the organization that they're going to build over a period of time. That gives great confidence, because all said and done, while we treat founders as these superhumans and supermen and superwomen, at some level without their teams, they are incapable of achieving anything. So if they are at the earliest stages without any capital or material amount of capital, without any progress, revenues, MIS, etc., or PR or recognition, if they can mesmerize really high quality people to come join them in their journey, that to me is a very, very strong indicator of the quality of the founder and their ability to build an organization that will deliver on their vision in the future. I would say these are, in my mind, one is how to approach investors, and outside of the basic stuff, everyone will talk about the TAM and all the usual stuff everyone is very smart about. But what I find usually missing is emphasis on the broader team, which I feel can be a real deal maker in some ways.
Great. So I think we've covered what I thought are most areas. If there's something I had missed to ask you, which you think we do want to tell a young early stage.
I think you asked a lot of really good questions, and I feel that we covered a lot of things, but this is a vast topic, and one could probably keep going on and on. I do feel one thing that is often asked by early stage founders is around culture, right? That how do you build a great culture? Because culture is often equated, at least in Valley terms, to free food and free parties and free massages, etc. Obviously, all that is changing in today's financial environment. At least I've seen in all the companies we built, whether investment side or operating side, the average tenure is more than 5 years. And that's an eternity in the startup world. And the reason for that is we've always emphasized on transparent, frequent, and honest communication. Because when founders are transparent, honest, and frequent in their communication, when times are tough and every company sees its tough times, that's when your team stands shoulder to shoulder with you to help you tide through those periods. So I've always recommended to founders that from day one, even when you have 3 employees, just communicate, and that'll serve you well in the very long run.
Excellent. I think even the earlier panels, I think these ideas are echoing, and I'm imagining myself to be an early stage and see, okay, which are things which everybody is saying, and you've touched on some of the things that others are saying as well. So I won't try and summarize, except to pick some nice sentences. You said that in the area of focus and early profitability, and what range will it be? So is it a squirrel with a tail or elephant with a trunk? You have to at least figure out what you are getting into, and of course, as you said, that focus is key, and focus comes right not only here. Focus also comes, as you said, when you're looking at where do you want to be distinctive, not only the market, but also how, the one thing in which you'll be really good and 10x better. So focus comes through clearly, and not as a surprise that personal passion should be the starting point. And so get rid of the fluff which is happening, be in touch with yourself, you're saying, and listen to what you're saying, and you use the term irrational energy. You should have irrational energy and take your time, I think, to figure out, because it's an important question. It's not easy to figure out. You made that very important point. And I think in looking for capital, of course, looking at which other people who invest in that area, but much more than that, what will they look for, and present your depth of talent quite clearly. I think that's very important advice, because people just look for a team. And I think you're saying, in the spirit of transparency, let people see what you see as your depth of talent, with pluses and minuses. And transparency, I think, in being there to say, this is it and this is not there. And so that's very important. And on regulation, you used a very nice phrase, which is follow the tailwind. Don't look for opportunistic things, because it can hit very, very hard. So with that, thanks so much. I think it's been extremely valuable to me, refreshed many, many ideas and brought in some new ones. And I'm sure that our participants and people who are attending will find a lot of value in what you said. And so once again, thanks so much, Kunal. Very, very grateful to you for finding the time.
Thank you, sir. Thank you for having me. Really appreciate it.
Back to you, Neha. Thank you so much.